Hello and welcome all. This is Shrinath Diwan here from AIF and PMS Experts India Private Limited. This is our show called Ask the Experts. We are a digital platform wherein we manage. We are a digital platform where we manage alternative investments and portfolio management services portfolio of our clients. We use the in-house and proprietary based 3I framework to select the right portfolio manager and help the clients to create long-term wealth. Our framework helps us monitor quality, compartmentalize processes, and assesses risks and returns. Our platform, a platform which is founded by Mr. Vikas Agrawal, who has a two decade of domain expertise. Vikas has become well-known name among most of the HNI families in India. He shares his knowledge of alternative investing through podcasts, educational blogs, and other mediums available at www.aifpms.com. He has interviewed the best 100 brains for equities in India and shared their wisdom with all the client members of AIF and PMS Experts India. Now, today with us, Mr. Vikas Gupta, CEO and Chief Investment Strategist in Omni Science Capital. He's a founder of Omni Science Capital. Mr. Vikas Gupta, he's the architect of the scientific investing framework applied to equity investments. He holds a BTech IIT Bombay, MS doctorate from Columbia University, New York. He has also served as a scientist and professor at University of California and IIT Kharagpur, respectively. He has been invited to write for Indian and global publications such as Money Control, Mint, Economic Times, The Street, USA, and Seeking Alpha, USA. Dr. Gupta is a natural philosopher applying the scientific method to reimagine investment management. Welcome, Mr. Gupta.
Hi.
Hello. Mr. Gupta will be representing ACMIL, Portfolio Management Services today. We will be discussing with him about the PMS products offering of ACMIL. Over to you, Mr. Gupta.
Thank you. Thank you. You have to enable share screen for me so that I can share the presentation.
Yeah. I have made you host, Mr.
Okay.
Vikas.
So I can share now. Perfect.
Yeah, now you can share.
Super. So I think everyone can see my screen now.
Yeah.
So this is the portfolio management services from Asit Mehta, ACMIL. So the theme is Invest in Bharat Amrit Kal. Okay. And we will talk about some of the themes which come up, or as we call them, growth vectors. Okay. So this is a very old firm. Asit Mehta is there for nearly 40 years now in business, or maybe 1 or 2 years less. Founded by Asit Mehta and Dina Mehta. So I'll not get into all this. So you can see the promoters of the company, directors, etc. Main important point for uh, people interested in the PMS is that for uh, ACE multi-cap strategy earned the 5-star rating, okay, from CRISIL, and it was of the top 10 performers for last 1 year. You know, numerous
Interesting.
awards achieved by the firm.
Interesting.
Yeah. Now, this is the main crux as far as investors are concerned. Okay. It is possible. I'm not saying it is likely. It is possible that India can cross even $50 trillion by 2047. Okay. Which is somewhat 2104. Yesterday we entered somewhat 2081, 2081. The new year has started in India, right? So this is a 25-year projection during the Amrit Kal, and it is possible that India gets to above 50 trillion. So we've done some estimates here, and based on different. Okay, so one thing I want to clarify here: how GDP works. People are confused with all kinds of numbers, and even earlier people were debating few years back whether India will become 5 trillion or not. I mean, that is a ridiculous discussion. There is no doubt India would be 5 trillion. Okay. It's a matter of when, 1 or 2 years here or there. That is all fine. Secondly, you have to understand when we talk about GDP, there are so many things going on. One is GDP, real GDP. Okay. So when people talk about 6%, 7%, 8% growth rates, those are real GDP numbers, real growth rates. Okay. That means that there is no impact of inflation there. That is without inflation. How much the volumes grew, you can say. Okay. Second number is GDP with addition of inflation, what is called nominal GDP, right? So when the rupee GDP is discussed in current prices, that is nominal GDP. And then you translate that current price into current dollars. So that is called nominal GDP in dollars. Okay. So when people were debating that it will never become 5 trillion by so and so year, the confusion was because you are using real GDP growth rate and trying to predict. And you will say that, okay, you need a 12% growth rate or something. But that 12% growth rate was nominal GDP growth rate. So in nominal terms, we were going to reach 5 trillion. Okay. Now, people will question this. So we have displayed the CAGR numbers here. And again, to bear in mind, these are nominal GDP. So it is real GDP plus inflation, whole thing converted into dollars. Okay. And then you can see that the base rate, India growing at a 10% dollar growth rate, nominal, which is not at all anything crazy. 7%, we have been doing 7 to 7.5% average for last 20 years, real GDP. You add a 5% inflation to it, that goes to 12 to 13% kind of nominal growth rate. You subtract 2% of depreciation. So that's around 11% of 10 to 11% nominal dollar growth rate of India GDP. That's been going on for last 20 years. Okay. And that's the base case. If you see 9.8% CAGR over next 25 years. So that is absolutely what we have continuously, consistently delivered as a country. Different regimes, global financial crisis happened, governments changed, all of that happened, and we are still at 10% kind of a compounded growth rate in dollar terms. So that is the base case. Things are lower than that on the conservative side. Things are slightly higher than that on the aggressive side. And there is a reason. When you start exporting, your depreciation first, the rupee doesn't depreciate anymore against the USD, right? First is on par for some time. And when you start doing very heavy exports, you actually have an appreciation of the rupee. So you are actually growing at an even higher dollar growth rate, nominal growth rate. Anyway, so having explained that, the base case itself takes us to nearly $40 trillion. Okay. So this is just doing what we have been doing for a long time. There's nothing new. If we have very good policies, if there is an inflection point, if we have changed things slightly, for the better from the previous era, then we should be doing, in the optimistic case, 60 trillion, and it could be as high as 90 trillion plus, which means we would practically be the number one economy in the world. Okay. And this is our own calculation, but I have seen some global banks also come out with similar things that India could be number one by 2050 or so. Okay. We are projecting till 2047 here. And even in the worst case, you can see very conservative case, which is 8% dollar returns, nominal GDP rather. This is 24 trillion. Okay. So all very, very large numbers. In all cases, anyway, we know that in next 3 years or 4 years, we will be the number 3 economy in the world. Right. So it will be US, China, India from somewhere around 2027 or 2028. We'll be crossing Germany this year or next year, and then Japan in next 2-3 years after that, right? And we would become number 3 economy in the world. So the problem, this is a great thing, but some people will say, okay, you are such a populous country, so having a large GDP is still you are a poor country. So let's address that. That are we still a poor country or are we a rich country? Okay, that's why you have to do GDP per capita. So we have taken population out of the equation now, right? And we are looking at this, and in the base case, we are at $23,000 per capita. And in the very conservative case, we are still nearly $15,000 per capita, per individual. Okay, which is, you can see from the table, we have given the different per capita incomes, that anything about 10,000 to 12,000, you can say is like a developed market country. Okay. So we are reaching into that regime. Even in the most conservative case, we are at 15,000, but the base case is 23, which is something similar to Poland today. Okay. And getting to 50,000, which is above Germany today. That the most aggressive case. Okay. So in all cases, it is highly likely, nobody can guarantee that it will be so, but all calculations show that India will become a developed country or Viksit Bharat. Okay, it's quite likely.
Just to interpret,
Yes.
Just to know for our viewers, is there any back testing to this data?
No, this is not back tested. This is projections. But as I mentioned, that India has been growing at more than 7% real GDP growth rate for last 20 years, 7 to 7.5%. And there were times when we grew at 8% plus for consistently for 3, 4, 5 years. Okay.
Basically, what I would like to ask, if this GDP per capita of 2612, where we are standing now, is there any backtesting for developed countries in the history of developed countries?
Yeah. So we are at 2,500 or 2,600 per capita today, dollars, right?
Correct.
China was there at somewhere around 2007.
Oh, interesting.
Just to benchmark, right?
Yeah.
So 2007, where China was, we are there. And the thing is that once you cross 2000, there is a very high speed till $10,000. So from 2000 to 10,000, there is a number of countries which have grown. Once they cross 2000, there is a fast growth to $10,000 per capita. And then some countries get stuck in what is called the middle income trap. They get stuck at 10,000, they're not able to go higher than that. We are unlikely to face that problem. There are different reasons why they get stuck. But we have ample natural resources, we have ample human talent, and we have ample, land mass, etc. So many other resources that we are not going to face that problem. It is possible, but unlikely. Okay, less likely.
You want to say that we are diversified as an economy enough, right?
Exactly. And we can keep coming up with new sectors where we can grow. While for many countries, because they are small countries, they grew very fast in one sector, they dominated it, and now they're stuck, right? Even if they don't have enough manpower itself to get into another sector. Or maybe the natural resources is the constraint. or geographic location is the constraint. I mean, look at us. We have huge coastal line. We have huge landmarks. We have road connectivity with multiple countries, port connectivity, with air connectivity. So we don't have these kind of issues. Okay.
Thank you.
Yeah. Yeah. So investment focus, yes, there is US economy opportunity, there is AI revolution, but today we are talking about India, right? So India, of course, there is a huge opportunity. Now I'll get into directly into the what differentiates our investment philosophy, and this is the core insight we have, that most market participants, especially when you talk about stock market, everyone talks about how much returns they will generate. But we think that's the wrong approach. When people chase returns or alpha, what they end up is with risk. Okay, majority of them who chase alpha will end up with risk, which means your returns are gone, your capital is also getting destroyed. Whether it's destroyed fully or partially, that's a different question. But you are actually getting risk is a problem. Okay, people say I like risk. No, what they actually want is the high returns they think they are going to get. Okay, but when you chase returns, you get risk, and when you chase safety, you can get alpha. Okay, that's the insight. That's the whole thing we are based on. How that has developed, I will not get into that. We don't have time for that. Okay, we'll skip. It is based on 100 plus years of investment research foundation, and it is built on philosophy, the concepts from many, many great investors. You can recognize some of the faces here, like Warren Buffett, of course, everyone knows at the center. And his guru is Benjamin Graham. His other guru is Phil Fisher. So Benjamin Graham taught him margin of safety. Phil Fisher taught him how important growth is. John Burr Williams, who decided how to do the DCF, the first version of DCF, which is dividend oriented valuation. Peter Lynch, Charlie Munger is and so on. There are many, many concepts we have incorporated, but it's not that they're randomly lying around. The whole thing is that they have been integrated into the scientific investing framework. And some of them have flaws also. Those also have been addressed in scientific investing framework. So a lot of flaws have been taken out from different philosophies, including there are flaws in, Charlie Munger's framework. Okay. There could be flaws in Warren Buffett's framework as well. Or there is no flaw, but it's what works for him might not work for you. Okay. So we have put in what will work for you today, not something which Warren Buffett said in 1985. Okay. World has completely changed. So we have applied all those things based on first principles and logic. And this is what the framework is. So our investment universe, we start with the whole market. And the first thing is we take out companies below approximately 1,000 crores market cap. Because they are very small companies. There is not enough information about them. We don't want to go there. Okay, there could be corporate governance issues and all that. Above 1,000 crores, there are anywhere between 1,000 to 1,200, 1,300 companies today. That is our remaining universe. From that, we start taking out companies. So let's say there are 1,000 companies approximately in the universe. And let's call the return of that 1,000 companies as Nifty 1,000. Nifty 1,000, Nifty 500, Nifty 50 will be roughly similar returns. Okay, most of the time. In some short period, they will deviate. But mostly because they are dominated by the larger companies, the Nifty 1,000 return is Nifty 50 return, approximately. So let's say, you call the total return of the top 1,000 companies as Nifty 1,000. But in these set of companies, we don't like certain companies because there are certain loss-making companies which consistently make losses there. There are companies which have consistently bad balance sheets, which means lot of debt on the balance sheet and very little equity. So if anything goes wrong, the lenders become the owner of the company, right? So all these kind of companies we call capital destroyers. And there are many of these companies in the market. So we just take them out. So Nifty destroyers are out. So let's say out of 1,000, 300, 400 companies are out, 600 are remaining. So So Nifty 600 is likely to have higher returns than Nifty 1000, right? So one notch higher return and one notch safer, right? Because I have taken out all the kachra companies here. I cannot say all, but a lot of kachra companies I have taken out. So it is Nifty 1000, Nifty 600 is better than Nifty 1000. Now, this is not your, this is a different 600, not the largest 600, right? The
Yeah.
cleaner 600, you can say. Now, next step. So, you have achieved higher returns and you have achieved lower risk at the same time. Next is capital eroders. These are companies which have low profitability. So, they don't have any competitive advantage. Okay. Because they don't have any competitive advantage, they don't have any pricing power, so they cannot have extra margins compared to the competition. They cannot have extra profitability and so on. So the longer you stay with them, the lesser they are going to generate for you. Okay. On the their own assets, okay, the capital investment the company has made on the shareholder capital, the return is less. So we take those companies out also because it was better that those companies put into fixed deposits rather than doing all this business. So capital eroders are also taken out. Let's say 200 more companies are out. So you are left with Nifty 400 also. So Nifty 400 is now two notches higher returns than Nifty 1000, most likely, and two notches safer. Third thing now is all the remaining companies are likely to be high quality companies with strong balance sheets, high profitability, some competitive advantage, or even strong competitive advantages. But there is one problem still. One problem is that many of these companies are great companies, but market also knows about it. If market knows about it, they are likely to be overvalued. And when something is overvalued, if it fumbles even little bit. So you are expecting a company to grow at 25%, and then it says I will grow only at 21%, which is a great growth rate. But the share price is likely to implode, right? So overvaluation creates this problems. So we don't like overvaluation. We take out capital imploders, which is overvalued companies. Now we are left with, let's say, 100 odd companies, 100, 120, 150, or sometimes even 70 or 80, depending on where market levels are. So now you have three notches safer portfolio and three notches expected return is higher. Okay, at the same time. So safety part is taken care of now. Now we move to enhancing the growth potential of the portfolio. So from this set of 100 odd companies, plus minus 20, let's say, we start trying to figure out which have high growth historically and which are likely to continue the high growth in future. Now you will continue high growth for the long term in future. Excuse me. You are likely to do that if you are exposed to what we call growth vectors. Growth vectors are things, are opportunities which are driven by growth drivers external to the company. For example, technology or AI. AI is an external growth driver, right? Company can capitalize on it, use it, and grow very fast. Or so it can be technologically driven, as in artificial intelligence, metaverse, or digital transformation, or blockchain, or cloud, right? All those kind of things are technologically driven growth factors. There can be socially driven growth factors, as in there is a trend for fitness and wellness. So people don't want fried stuff, high calorie stuff, or sugary drinks, right? They'll go for more organic drinks or more organic food or more healthier food, right? So that is also, or they will go for exercises or activity. So things which ride on this growth factor are socially driven growth factors. So it could be socially driven, it could be technologically driven, it could be regulation based. So suppose there is encouragement for exports of certain sectors and you are giving performance linked incentives from the government. That is a government driven growth vector. There could be a regulatory growth vector where, let's say, they say that environmental laws become very stringent. So some hazardous company or polluting companies will or sectors will get affected negatively, and some companies which are providing products or services to solve this problem for those sectors will get a huge positive growth factor, right? So there are a number of triggers of growth factors. So we identify company by company, try to see who has good growth potential in future and isolate those companies. This is a more detailed version of what we do when we talk about it. I will not get into it, it's too technical. But the point is that we are able to typically identify 5 to 6 different growth factors. These growth factors are driven by different growth drivers, right? So they are less correlated with each other, which means if something goes wrong in one growth factor, the other growth factors are not going to be impacted by it. Plus, the unlocking happens independently. Because finally, we are buying something which is not recognized by market, which is cheap, and we want to sell it off when Mr. Market recognizes it. Okay. So what happens, let's say I have 6 growth vectors and my holding period is 3 years, then the chances, because they are independent, every 6 months, one growth vector is likely to unlock. And so my portfolio returns become more consistent. Some part of the portfolio is likely to deliver every quarter or every 6 months and so on. All of them will not work out at the same time, but then consistency is increased. So this is the idea of the growth vector. So finally, what does the portfolio look like? Portfolio has around 25 to 30 companies typically. Right now, there are more than 30 companies, but that is exceptional. We found a lot of cheap companies last year, so we added them. But otherwise, 25 to 30 companies, 5 to 6 growth vectors. So each growth vector will have 5 to 6 companies. And there are 5 to 6 growth vectors. I will not get into this, how we identify what is undervalued and all that. So there's so many patterns or models.
Correct.
It will become again very technical. We'll directly go into the current growth factors. Excuse me. So right now, rail infrastructure is one very strong growth factor. You can see the kind of opportunity. The total addressable market is something like 50 lakh crores. Driven by what? So there are 8 high speed, which is basically what we call bullet train, right? So bullet train is a brand name for the Japanese high speed train, but 8 high speed projects going on at different stages. The most active is obviously the Mumbai Ahmedabad, but there are many others at earlier stages. So over next 2 decades, around 8 such projects are going to be going on. Around 1200 plus stations are under redevelopment. Now, if you look at the New Delhi station redevelopment plan, that design is more amazing than even the best airport in the world. Okay. So things are going to look visually also very, very attractive. Of course, it will have all kinds of amenities and all that. And some of the other, smaller stations will just have a renovation rather than, or a refurbishment as compared to. So, but there are all kinds of very large number of projects going on. 25 to 30 plus metro, which everyone is familiar. Across India, all the big cities are having metro projects going on, right? More than 400 Vande Bharat trains, more than 3,000 other trains, right? Many of you would be familiar with these things. And then the dedicated freight corridors, the Eastern Corridor and the Western Corridor. So Delhi to Mumbai, you can say roughly, and Delhi to Kolkata, the dedicated freight corridors. The idea is to move the freight from roads, which is less efficient, to railways. So the opportunity is that freight will go up by 3 times in next 10 years. So these are extremely large opportunities. And this is just one growth vector. You can see how the railway budget has grown by more than 15 times in 13 years. Excuse me.
Yeah.
Digital transformation we mentioned. So technology driven. So this is a very, very large opportunity worldwide. But so the largest companies, the top 1,000, 2,000 largest companies in the world are going to adopt this digital transformation. The largest governments are going to adopt it. But who's going to carry this out? There are 5 large global companies like Accenture, Capgemini, Cognizant, etc., IBM, etc. And there are 15 large companies in India. Majority of the work has to be done by Indians, whether through those
Right,
5,
right.
6 international companies or the 15 Indian companies.
Yes.
Okay. So that's a very large pie which is going to last for next 10 to 20 years. That includes cloud, AI, 5G, 6G, all that. Internet of Things and all that. Third one is defense. India is the 4th largest spender in defense in the world. Defense exports, we were never known for exports. We were the biggest importer. We are still the biggest importer in the world. But we are also becoming an exporter. So last several years, we have been growing at 20% CAGR. And we have defense attaches in more than 80 countries in the world. So once you have someone trying to market, once you are applying for those air forces or navies or militaries and pitching your products, so that all is happening. We are reaching the final stages. Sometimes we have also won, right? So we have exported the BrahMos missile. We reached the last stages for Tejas, etc. In many cases. So that is going to increase going forward. And our target, according to the defense plan of 2020, we are going to be doing 175,000 crores of production, defense production domestically, and about 5 billion or 35,000 crores of exports. That is the target for till 2025. Sorry. No economy, we discussed how Indian economy is likely to grow. No economy can grow without power, right? Power is what is going to drive the growth of the economy. So the unit demand itself is around 13% CAGR. The price is a separate factor on top of it, right? Unit price. And the opportunities across the ecosystem. So there are generators, there are transmitters, there are financing companies, there are equipment manufacturers, there is clean energy, renewables. So many things are when you say power. So it's not just the company which sends you the bill for your power, right? Most people think of those companies where a user is using, but there are so much rich ecosystem there. And if you're going to do all these, like, investments in railway infrastructure, road infrastructure, power infrastructure, etc., where is the capital going to come from? So capital enablers. You need around 100 plus 100 lakh crores of equity financing and 100 lakh crores of debt financing in the next few years. So that requires banks, that requires infrastructure NBFCs, that requires rating agencies, right? Who's going to rate all that debt? That requires stock exchanges. Where are you going to raise all that equity? Or where are you going to list the debt? So there are all these opportunities. This is a very rich field and it is undervalued, significantly undervalued. Related to that is Bank on Bharat. a subsector of the capital enablers, only the banks. That itself is a huge huge opportunity. The important thing is now the balance sheets are clean after the NPA cycle and the cleanup cycle. ROEs are expanding, which means earnings are likely to accelerate over next few years. Which means what? That if revenue growth is X, the earnings growth is even higher than X. Okay. So this is a huge opportunity, and of course, digital banking. So digital banking, we think the traditional banks are stronger than the new fintechs on some aspects. And then mobility. We all are aware of the electric vehicle demand, right? How that growth is happening. Then green hydrogen, then metros, then regional rapid transport, all kinds of, when you say EVs, it's not just the companies which produce the electric vehicles. There's somebody who's providing you the batteries. There's somebody who's providing you the charging infrastructure. There's somebody who's providing you the financing. There is somebody who's providing the chemicals for the batteries or other consumables to produce batteries or equipment to produce batteries. Then there are rare earth metals which go into the batteries. Then there are power storage. And then finally, of course, power supply, right? So all these things come together just on EVs. Similarly, green hydrogen, similarly, other modes of transport, including waterways, airways, ropeways, right? Eventually, there will be hyperloop and so on. So this is that growth vector. So these are some of the growth vectors that will keep changing as time goes on. So what are the product offerings? So there is the multi-cap, which is the flagship product, ACE multi-cap. There is ACE 15 or ACE large cap, you can call it, ACE mid cap, and something called ACE regular income. So ACE multi-cap is what we just discussed. With the philosophy, what I implicitly explained is that it's a quiver full of arrows, growth arrows. So you can see how it has performed over the last few years, 2018 till 2024. It's more than 3 times, So this is comparison with some of the large PMSs, the peers. So the point is, it not only is doing better than the index or the benchmark, but it is doing better than most of the prominent PMSs. No point in getting into who's which PMS. You all know the top PMSs. It is doing way, way better. And actually, if you compare those other PMSs, they are lagging even the index. Okay. So then this is significantly, way, way out of the performances, way beyond the average. So you can see the performance, etc., and what we have. The regular income, again, is a very attractive thing, which people like. The idea behind this product is that it pays out 0.5% of NAV every month. Okay. So you are assured the payout. Now, it could be part of the capital itself when markets are down. Okay. So sometimes it will be part of that. But most of the time, it will be from the returns. The point is, whatever is the NAV at every month, first week of the next month, you get a 0.5% of payout of that.
It will work as a STP type of a model.
It is like a SWP, you can say.
Sorry, SWP type.
Yeah, but the difference is that in SWP, you have a fixed amount and you keep withdrawing, and actually the remaining capital keeps getting smaller. Here, that will happen only during market downturns. The rest of the time, actually, the capital is likely to grow. If you take the long term, the capital is likely to grow faster than inflation. That is the objective. That is what we are targeting to do. that capital grows faster than the inflation. So your capital is also growing and your payout is also growing in the long run. Okay, that is the idea. So if you have 1 crore today, you are going to get 6 lakh rupees in a bank fixed deposit. Here also you will get, let's say, approximately 6 lakh. Right? It could be less also, slightly. But 10 years from now, in the bank fixed deposit, you still have 1 crore and you still get 6 lakh payout. But here we expect that the principal is bigger and the payout is also bigger. And of course, it has the equity risk. There is a significant portion of equity, but also other asset classes. So other than equities are also there. Okay. So debt is there, gold is there, etc. This is the large cap portfolio, selecting about 15 to 20 stocks from the top 100. Strictly. Okay. So this is not strictly picking from the top 100. Mid cap again is the next 150, a 20-25 stock portfolio from the next 150. Again, I mean, performance I'm not getting into it. You can see for yourself. It's better than the market, it's better than most of the peers. Anyway, fees and all, you're all familiar. I'll not get into that. Equity markets are obviously risky. So read the disclaimers and disclosures properly and understand the risk. Anyone who wants to do short term is not welcome. Everyone who wants to do 3 year, 5 year plus, has the patience, has the understanding of equities, is welcome.
Thank you. Thank you, Mr. Vikas. Thank you for this detailed discussion on your offerings. Our viewers must have got idea of your themes. Thank you for giving us your valuable time, and here we will conclude our discussion right now.
Sure.
Thanks.
Perfect.
Thanks.
Thank you.
Thanks.
Thanks.
Bye.
Okay. Okay. Bye.